Hi, my name is Bob Collier and I'm with RTP Business Live. Today we have the pleasure of speaking with Patrick Yanke of Yanke Financial. Patrick, welcome to RTP Business Live. We're glad to have you today.
Thank you, Bob.
Let's kick things off and find out a little about you personally before we delve into Yanke Financial.
All right.
What can you tell us about a little bit about your background and how you came to this point of the firm that you have started and founded and run for a number of years now?
All right. Well, it's a bit of a story. Back when I was a junior at the Air Force Academy, my dad's boss, my dad was with A.G. Edwards at the time, and his boss called me out of the blue one day and said, if you ever leave the military, I want to hire you too. So all the way through my Air Force career, I knew what I was headed to. I did financial presentations for my troops, how to manage money, all that sort of stuff. And when the time came to leave, I went down to Panama City, Florida, and joined with A.G. Edwards, and pretty quickly realized I'd made a mistake in terms of location. You know, my family, we're not hot weather people. So we started looking around the country, looking for where we should be, and we settled on Raleigh. So after 5 years, we moved up to Raleigh, and I brought my business with A.G. Edwards up here. Mm-hmm. But then that was 2005. In 2007, of course, A.G. Edwards was bought out by Wachovia. In 2008, Wells Fargo bought Wachovia. And in 2009, I went independent. And one of the reasons was that I got calls from clients in the process each time. They said, don't worry, we're not with the firm, we're with you. Well, it made an easy conversation when the time came that I opened my own firm and under my own name said, okay, it's official, you're with me. And so
that's the kind of feedback you want to be getting from your clients.
Exactly.
That feels pretty good.
Well, I generally work with family and friends. And they're not all friends who became clients. They're clients that become friends over time because you get so deeply into people's lives. You get to know the kids. You get to know their goals for life. And so I have very close relationships with the people I work with, and I appreciate that.
Well, it sounds like you have a great background, and it was almost in the blood from your days in the service, and thank you for your service.
Absolutely.
We appreciate that. Where's your specializations, if you will?
Well, it's hard to say about specialization. I'm a certified financial planner, so I'm versed in all financial areas. That's the highest certification in the industry. So I've gone through, tax planning, retirement planning, estate planning, college planning, all that sort of thing. So I'm versed in all those areas. If I would say there's one area that I specialize in, it'd have to be probably estate planning. And the reason for that is people die. It is a reality, and you need to prepare for it.
Wait a minute.
It's true. I know it's a shocker, but it's true. And when you look at the realities of death, you're going to leave something behind, either problems or solutions. And for the person who's young in life, who hasn't had a chance yet to build a nest egg for his family, insurance might be your nest egg. So estate planning for somebody just starting out might be an insurance policy that says if you pass on, your family's got something to take care of. But there's other things to consider as well. When you start having kids, who's going to take care of the kids if you're not here? What about their future college education, that sort of thing. But when you get later in life, the conversation shifts a little bit and says, okay, now you've built up a legacy. How are you going to pass on this legacy? So all phases of life, estate planning is a very important conversation because you will die someday.
It's a tough conversation to have.
It is. Not everybody retires. Everybody does die.
Right. And thinking about that is tough for a lot of folks. Your philosophy, I know obviously estate planning is an important piece, but financial planning in general, what's your philosophy and how do you work with people and help them understand that?
My philosophy is generally, I'd have to say it's a Christian philosophy, but essentially I treat people the way I want to be treated. I don't want to be feed to death by anything that I do. I don't want someone looking at me and saying, oh, good, here, my piggy bank just showed up. So really, I want to treat people as human beings. And my key is just to listen more than I talk. I try to ask the questions that they may not have thought of and to have that conversation with people to know what it is that really drives them and is important to them for the future. Because, life isn't about the finances, but life without finances isn't a whole lot of fun either. So when you say, okay, I want to buy a house someday, I want to send the kids to college someday, or I want to retire someday, there are dollar amounts that are tied to that to have the quality of life you want with those things. So that those all come back to the conversation to say, okay, how much should you save? Where should you save it? And all that, the conversation comes from that. So really my philosophy is to try to listen more than I speak and to listen to what people are trying to tell me about what's important to them and try to help them reach their goals. Because financial planning isn't about me. It's about the people sitting in front of me.
So you could help folks in a number of different areas. I mean, it's not a one-size-fits-all.
Exactly.
Here's your financial plan. You really need to know about that individual and what their goals are, or about the family and what their goals are.
Well, we say it's a relationship business, but it absolutely, if there is no relationship, there's no business relationship. Because, again, your finances are about your life. And if you're only going to focus on the finances and not the life, then you don't know what you're saving for, and the financial planner doesn't know what he's doing, quite honestly. So that's really the key to the whole conversation, is what's important to you. And once you start getting into what's important to somebody, you're starting to learn more about how that person ticks.
Absolutely. Well, you touched on this earlier, and it's a hot button issue, I think, for a lot of folks. But how are you compensated, and how does that figure into the picture of what I would get from my financial planner?
Okay. Well, number one, I don't charge for conversations. So you'll find that...
You're not charging me for this?
I hadn't even thought about that. But no, I don't. And the reason is I don't want people to think cha-ching anytime they call me, whether it's a client, prospect, someone that someone's mother that has a question. I don't want them to think, what's this conversation going to cost me if I talk to him?
Right.
So I talk to everybody. Somebody walks in with $5,000 to their name. Well, let's sit down. Let's map out what that can do for you. Doesn't mean they're necessarily going to become a client. I mean, I have to be very selective. It's just me, so I have to be very selective in who I take on as a client. But I will talk to anybody, and I won't charge anybody for that conversation. So I encourage people to come and get a review and see where they are, and then map out a plan. And we'll figure it out from there whether or not there's a client, professional relationship in our future, or if it's just advice that I can offer right now. But again, that's not the key. In terms of actual compensation, though, if like I mentioned a moment ago about estate planning, if I sell insurance, you make money off an insurance sale. If we do stocks and bonds, there's commissions paid on stocks and bonds. If you do mutual funds, well, mutual funds are interesting because they have their own fee structures and stuff built into them. So if you do what's called upfront mutual funds, then there's break points for investing more money. So if somebody comes to me with $1 million and when they invest that into a single fund family, there's no charge for investing into that single fund family. However, on a fee-based relationship, the fee-based relationship is really good for the financial planner, not always the best for the investor. And the reason I say that is because, okay, you take that mutual fund portfolio and now you put fees on it. Whatever the fund is charging, the broker is making fees extra off of that. And the average fee on $1 million portfolio in the industry is nearly 2%. So
that adds up.
It adds up. So you say, okay, well, I wouldn't have paid anything up front by going with a single fund family if that fund family makes sense. Or, of course, break points further down, versus I'm going to pay 2% on the value of the assets every single year going forward. I haven't found where that trade-off really works well for the client. So I've got very few fee-based relationships. I use them where they're appropriate for the client. They would work out great for me, but I'm try to do what's right for people, and I don't want to be feed to death. I'm not going to do that to anybody else either.
Absolutely, and the importance of having a long-term relationship and having that person feel comfortable referring you to folks that are near and dear to them.
Exactly.
They want to feel like that you're going to treat them that way, and
exactly.
And so I think they feel comfortable with that.
Well, and you hear these horror stories about people like go out to Hollywood and they want to grab all the money they possibly can while they can, and they burn out. If you want to be in the business for the long term and you want to have long-term relationships, then the most important asset you have as a business manager is the people you're currently working with. So my main marketing plan is taking care of my clients, and with the referrals and things that they send, they take care of me. So it's a good relationship.
Let's shift gears a little bit. Let's delve a little bit broader now and talk about some of the challenges that we face out in the marketplace. What would you say probably are the biggest challenges out there right now for people to be safe but grow their portfolio for the long term?
Sure. Well, the biggest problem that we have, I think, is the overabundance of information. And you say that it sounds kind of funny, to say that there's too much information, but it used to be that when people could find financial information, that was the information. But now, with the overabundance out there, people can just get inundated, and it's all contradictory, because so much of it is just sales literature. This person wants you to buy this for this reason, buy this for this reason, and it's all sales literature. So really, the biggest challenge is sifting through the information to know what's real. And I think one of the biggest things that people have to recognize right now is the long-term trends. So when you look at things like, for example, bonds. Bonds typically have been the go-to place in retirement. They're
right.
considered to be the safe, or at least the less volatile alternative to stocks. The last 30 years, we've watched falling interest rates in general. I mean, there's been some spikes in there,
Right.
but generally falling interest rates. That's a great environment for bonds. There's an inverse relationship between the value of the bond and the yield that it pays. So as interest rates were falling, bond values were doing great. We're at rock bottom levels with interest rates. I mean, there really isn't much room for them to fall. Yes, they can, but if they do, they're not going far. From here, we're most likely going to see rising interest rates. And the previous 30 years, when you look at 1950 to 1980, was a period of rising interest rates. When you go back and do some studies on that point, what you find out is people that were in fixed income, that were in bonds in that environment, they didn't keep up with inflation by half. So that's a very dangerous place to be if you're going to park your money in an asset in your retirement for the less volatile alternative to watch your value actually eroding against your spending power. When you find that bread is getting too expensive and milk is getting too expensive. So the biggest challenge right now is for people to recognize that the traditional relationship of risk and less volatility where people just shift towards bonds, you can't do that reflexively and automatically right now. You've got to be very cautious in the fixed income and debt markets because as interest rates rise, you will lose value going forward over time, and that loss of value is going to hurt you.
So that assumption that kept a lot of our older friends and possibly parents safe and in good shape may not be the best way to go for us.
Exactly.
In certainly the midterm approach.
Exactly, because when you look at when you look at what the nature of the markets is, people talk about risk. Right now, you're managing risks. There's no way really to avoid risk. You say, okay, well, I'm not going to invest at all. I'm going to sit in cash. Well, you're going to lose out to inflation then. The only
Right.
environment where cash is good is in a deflationary environment where every asset value is falling except cash. We're not
Right.
really in that environment right now.
That would be an uncomfortable place to be. I
Exactly.
hope we don't get there.
Exactly. So in a generally increasing inflation environment, as we are, cash is not the place to be. So you've got to decide between risk assets where you're going to put your money. I think bonds are very risky in this environment because, like I said, with interest rates, stocks are always risky just because of the nature of them. But if you're diversified, then you're generally investing based on economic fundamentals. And as long as the economy is growing, you're going to be fine. If the economy isn't growing, then quite honestly, we've got other big problems to worry about anyway. So those are some of the things that you have to consider in terms of managing your risk. And when I talk about the fact that bonds, fell, interest rates fell for about 30 years,
Right.
there is a rotation that happens among assets in the industry. And what we found is that when interest rates start about 2.5% on the 10-year Treasury, anywhere below 5% and start rising, universally that benefits stocks because generally the flow of money is from bonds towards stocks. Well, that's where we are with 10-year Treasuries right now. We are well below the 5% mark. As the interest rates rise, stocks are benefiting. So people look out there and say, well, we've got high unemployment. We've got all these problems that we have to face economically. Yes, but markets move based on the movement of capital. They don't move strictly based on economic fundamentals. Economic fundamentals attracts capital. There's other reasons for capital to move. And as people watch their bond portfolios getting hurt by rising interest rates, that flow of money is what's going to drive investment returns going forward.
So it sounds like, as you said earlier, there's so much information out there, and it's important to have somebody on your side who follows that rather than just blowing with the wind, whichever article you read that day online, that's the way I'm going to go, because
Right.
there's a lot more to it than just a quick broad brush of whatever's popular on Google that day.
Exactly.
I don't want to get too wonky now, but the federal government, the qualitative easing that I think quantitative.
Quantitative.
I knew I was going to mess up that term, but the quantitative easing that's going on right now, is that what's propping up the stock market, or what's going on there?
I get that conversation a lot from folks. They think that all these stock market returns, the economy is not really running on all cylinders, and yet the market's up 190% since 2009. They say that the government obviously is propping up the stock market. That's not actually the case when you look at where the money is going. Quantitative easing is really about keeping the debt markets liquid. For the last 3 to 4 years especially, the federal government's been the number one buyer of U.S. Treasuries. And the reason for that is because they don't know what happens if they get a failed auction. It's the old trade-off, supply and demand. So they are creating demand for Treasuries. So as the federal government is deficit spending and they need to borrow money, well, someone's got to buy that debt. So if there is no one else out there to buy that debt, that's where the Federal Reserve has been buying. And so they started off with QE1, they started off with QE2. You notice the last time they did not announce QE3, they announced QE infinity. They said, we're going to buy $85 billion a month till the cows come home, until we figure this out. Well, $85 billion a month, if you actually run the numbers on it, it's about $1.1 trillion. Does that sound
becomes
familiar?
real money pretty soon.
Well, it does,
doesn't
but that's also essentially the deficit that they're running. So all this talk recently they've had about tapering or trying to at least slow down the purchases or even stopping QE, it always comes with a caveat, unless necessary. That unless necessary means unless people aren't buying treasuries, in which case we're going to have to. That's their biggest risk because, again, supply and demand. If no one is demanding treasuries, then the value is going to fall, interest rates are going to spike, and the debt markets go into a big tizzy. So that's really what's been happening is they're propping up the debt markets. And what people don't realize is that the debt markets are actually, they dwarf the stock market many times over. You've got sovereign players, you've got countries and municipalities and states, and companies, all have their debt instruments out there in the marketplace. The debt markets really are not for the faint of heart. We consider them to be less volatile and all those sorts of things. But if you get into a failed auction on treasuries and those sorts of things start happening, you can get a real significant spiral there that's going to be dangerous for folks that are sitting on those assets.
So it's almost a little bit of a reverse mindset where the debt market is the risky
in a way
situation, and the stock market may not be as risky in the whole.
Exactly,
because the money is, they're trying to keep money in the debt market that may have gone to the stock market.
That may fly out.
That's an interesting.
Well, and you look at where interest rates are. Interest rates are so low because they want to drive assets to risk markets. They want people to be in stocks and that sort of thing. However, to keep interest rates where they are, they need to buy the treasuries in order to keep the markets liquid. So there's a huge trade-off there. And what the Federal Reserve has done is they built up a huge balance sheet that is largely with long-term treasuries. I mean, they've got the mortgages that they bought off, the bad mortgages back in 2009. They've got other things on their balance sheet. But when they're doing quantitative easing, primarily that is the long treasury. So when the long treasury, from where we are now, a 1% rise in interest rates from where we are now, according to JP Morgan, would be about a 19% loss in a 30-year treasury.
Wow.
People that are investing in treasuries are not investing in treasuries to lose money, but that is the reality of what's going to happen as interest rates rise. In fact, that's what happened last year. 2013, 30-year treasury lost about 15% value, and that's even including the coupon that it was paying. This year, they've actually done well because interest rates came back down a little bit. But again, like I said, the long-term trend is going to be that movement in treasuries. So it's not just when your issuer declares bankruptcy, you lose money in bonds. It's also as interest rates move and you watch your value falling. And normally I would tell people when you're going to invest in bonds, don't invest in a bond fund because you want to own the bond. You want it to mature someday. You want to have access to your money in that way and have the issuer mean something to you. In this environment, that's different. In this environment, you actually want to own the bond fund. Because when you look at your statement and see that value and you go to sell it, you're going to get that value out of your bond fund. When you have a bond and you're watching the value fall, it's an illiquid asset now. And when you say, okay, I want to stop the bleeding and I want to sell it here, the market may only pay here. So there's a lot of danger out there when it comes to holding bonds in this environment. As interest rates rise and you're watching your value fall, your value could even be lower than that because of illiquidity in the asset.
So a real change in how somebody needs to manage their portfolio these days.
Exactly.
And
you have to
need to understand how to manage their portfolio.
Well, they have to understand how to manage the portfolio, but also remember what they're managing it for. Because your portfolio is simply built on your future goals. So you're going to have close-term goals that might be you buying a house, car, or otherwise. Longer-term goals might be college for the kids or whatever else. And even longer-term goals are retirement and beyond. So managing your portfolio, the assets are important because that's what's going to get you to the number that you need for your goal. So you got to manage the assets as you go along, but the assets aren't the most important thing. The most important thing is the goal itself. Am I going to reach my goal?
Right. Let's dip. You were talking about some of the big macro trends and how they're changing how we need to look at our portfolio. One of the things that's big in the news right now, oil prices. Mm-hmm. I think they hit a 5.5-year low just the other day.
Yesterday I saw, I think, $54 a barrel.
And that's just phenomenal, and a real change in a huge market that affects just about everything in every market. What's that going to do for us or against us? Or
Sure. Well, number one, oil for us is a net. High oil prices are a net negative for us. And the reason for that is we recently became the number one producer of oil in the world, which is great. We produce about 13% of the world's oil, but we use about 22%. So that means that net to our economy, as oil prices rise, it generally hurts us. Even though we're producing the most oil, we're using the most. So lower cost of oil generally is good for us economically speaking. But there are a couple of risks that come with it. One is the jobs associated with the oil industry. As oil prices fall, then that starts to be a little less plentiful, so we might see some paring off there. But another one is that people don't see behind the scenes. One of the things that hurt us in 2008, it wasn't the mortgages that were a problem in 2008, the bad mortgages. It was the fact that the banks had plussed up their value through derivative products to 30 times their value, and that's the kind of thing that really put the markets into a tizzy. So as the price of oil is falling, people that have put derivative products on the oil that were shooting for the higher prices, that sort of thing can have an impact on the bank and financial markets. So that's one thing that's kind of hidden behind the scenes that we don't see. That's a very loosely regulated market that you don't always see what all the risks are there. So there are some risks associated with that. But one of the long-term risks that I'm kind of concerned about is, and I just heard on the radio yesterday for North Carolina, but I've thought about it before, governments need their tax money. And your gasoline taxes, a lot of them are based on the price of gas. It's a percentage base. So higher gas prices mean more revenue to the government. They've gotten used to those higher revenues. They increase their spending based on those higher revenues. They do their budgets on those higher revenues. Well, those higher revenues now with lower gas prices aren't as good as they once were. So they're talking about mileage taxes and some of these other things to try to get the money that they had budgeted that they were going to get. And the problem with taxes is they don't tend to go away. So we could find ourselves in a situation in the future if oil prices do go back up, that not only do we have the increased oil prices and the taxes associated, we've also got these new taxes they passed while oil prices were low that most likely stick around too. So that's one of the long-term risks I'm a little concerned about is governments and how they react to this. They need to learn economic fundamentals themselves and learn to tighten their belts when money is tight like we do, instead of just saying, give me more money.
If you can make that argument to them and have them listen,
if you're listening, this is how you manage money. Just like you do at home, do it for the rest of us. Thank you.
We will send that to the appropriate parties and keep our fingers crossed.
Appreciate that.
Well, that gives us a good macro look at the economy. What should investors do right now?
Well, every financial plan and every every portfolio begins with where you are. It doesn't matter what your goals are in the future if you're not set up now to try to reach those goals. So I would say everyone right now should be getting a review. Review your portfolios, your insurance contracts. Get a snapshot of where you are, and then also plan out where you want to be. Have that, as hard as it is, death conversation. What happens if I'm not here? Especially for retirees. We don't like to admit this, but retirement, the unique thing about that phase of life is it ends in death. It just does. No other phase of life has that. It will end in death. And it's not going to typically be both of you at the same time. So you need to ask that question when you're starting your Social Security payments, pension payments, all those sorts of things that are going to lead you through retirement. Okay, so what happens when one or both of you is not here? One or the other of you is not here? Are those payments going to continue, and can you live on what's left? So these are the kind of things that people really need to take stock of and say, where am I now? What's going to be in the future? And am I prepared for all that's coming? So number one thing that people should do right now really is just sit down and review.
Well, the all that's coming part is a scary part these days.
Yes.
I'm fortunate that both my parents are in great health, but when they get to the point where they cannot take care of themselves, which, as you said, almost like death, that's going to happen with just about everyone who doesn't die suddenly, those assets just go so fast. The health care needs, the attendance, the daily living care needs just ramp up so quickly.
They do.
That seems to be just a real challenge to plan for that part of life.
It is, and a lot of folks will take long-term care insurance for that, and that's not a bad approach. But recognize that a number of players have gotten out of that industry. MetLife and, escapes me at the moment, but there's a number of very large issuers of long-term care insurance that are no longer selling long-term care insurance, and that's because they mispriced it before. The nature of insurance, number one, it has to be what's called aleatory. It means it has to be an element of chance. It's like life insurance. You're going to die, but we don't know when. There's an element of chance there. The problem with long-term care insurance is that for a 65-year-old, there is a 50% chance that you need some sort of long-term care at some point in the next period of time, and typically the need is going to be 3 to 5 years. So that's what statistics tell us. So when you've got a 50% chance of actually using the insurance, then you really have to, it's a very expensive insurance. And so people have been used to getting $5,000 a year, $6,000 a year for a policy. It sounds like a lot of money, but if you pay on that for 20 years, and you've put $100,000 into it, what you've bought is a pot of money. And so that there's maybe $350,000 out there that's going to come back tax-free to pay for these issues. But within the first year or so, or even the 6 months, you're going to get a lot of that money right back. So the experience of the insurance companies is that long-term care is a very hard thing on an insurance basis because the necessity of it is so high. So I recommend people have long-term care insurance. If you're younger and you want to help to take care of your parents, maybe you buy the policy on your parents if they can't afford it in retirement, because it's still going to be your responsibility. Or the parents buy it because they don't want to be a burden on the kids. Whatever the case may be, long-term care insurance is a good thing, but I would recommend doing it while you can because the insurance industry is changing in this regard. Prices are going up and players are deciding it's not worth it, so do it while you can. Absolutely.
And it's one of those things where you mentioned earlier, start early. Don't wait till it is upon you to have that conversation.
Exactly. Most people, that when you're in your 50s, about when you want to have that long-term care conversation.
And this is a conversation that might not be just between you and your financial agent. As you mentioned, if it's the children and that's going to be their responsibility, that's a challenging conversation they may need to have with their parents.
Exactly.
And vice versa. The parents have to make their needs and wants known to the kids. So a lot of challenging conversations, but important ones to have.
No question. I think that's one of the problems that we face when we're talking to clients is the older generation, they generally did not talk about money. But you need to.
Yeah.
Because like I said, if you don't want to be a burden on your kids, then hopefully you've got enough assets not to, or you've got the insurance not to. But if you think you're going to be a burden on the kids at some point, talking to them sooner and allowing them to plan and prepare for it is a good thing.
Absolutely. Absolutely. Let's have a little shift of gears here. Help me out just from a business perspective, and you work with a lot of different types of folks at different points in their lives. How do you find those folks, and how do those folks find you? You want it to be a good match, obviously. It has to be something that they feel comfortable in and you feel comfortable, because it's not a, here's the product, see you in a year,
right.
or thanks for doing business with us, bye-bye.
Exactly.
So help me out with that.
Well, the number one way that I meet folks is through existing clients. So like I said, my marketing plan is the same thing as my service plan. I take care of the clients I have, and I think that everything will work out fine. One of the things that I learned at A.G. Edwards, it was a very unique firm, but what they said is, we take care of the clients. Well, really, the firm said, well, they take care of us. We take care of our clients, and we'll let God handle the rest. I mean, it was a very unique firm. In the year 2000, when I joined with them, they had a broker roundup for the first time ever in St. Louis, and Ben Edwards III at the time, family member, CEO, he got up there and he didn't just say, treat people the way you want to be treated. He actually read from Romans extensively of what that means to treat people the way you want to be treated. That's the kind of firm that it was. So that's really built into how I conduct business, is the training and philosophies that I learned from A.G. Edwards. And it's one of those things where, it's not different for somebody to think that way, but it might be a little different to think that way in business, because people don't always apply those kind of fundamentals to their business to say, all I have to do is just take care of the person that's in front of me and let God handle the rest. So it's that simple when it comes to the client service model. In terms of my own marketing, really the main thing that I do is I love public speaking. So years ago you do the estate planning seminar, you do the retirement planning seminar, but frankly it gets kind of stale after a while. So through the years I wasn't doing seminars. I was speaking for the Air Force Association. I was speaking for the Kiwanis Club, the Knights of Columbus. You name it, I was talking.
You've been there.
But not in my own business. After 2008 with the fiscal crisis, every conversation I had was, so what's going on in the world? What does this mean to my future? And that kind of dovetailed into what I call the capital markets review. And it's a conversation on what's going on in the world. This is where the real economic numbers are and what people need to know so they can make informed financial decisions. So every quarter, I do the capital markets review. It's updated every quarter as the numbers come out, so it's always fresh. And all people are welcome to come to that. Just go to my website, www.yankefinancial.com. There's a place there to send me an email if you want to be included on invitations for that. 'Cause I fire off invitations. And I also post it to Facebook, LinkedIn, Twitter, and that sort of thing. But in terms of, I'm not always the best at putting it on my website to say the next capital market review is, because I'm going to start marketing it really for the January presentation is going to be marketed in January. So there isn't a whole lot of lead time there to make web pages and the rest. And my industry is so regulated, it's very difficult to keep current as far as everything goes through compliance. So it's very difficult to keep current that way. So invitations go out. So folks that want to receive my newsletters, which go out when I've got something to say, it's not every week kind of thing, and include invitations to capital markets review, just contact me, patrick.yanke@yankefinancial.com or www.yankefinancial.com, and contact me and say, include your invitation list or your newsletter list, and I'll include them, and they'll get an invitation, and I'd be glad to host them and talk to them. The best part to me when I do the capital markets review is not me speaking, because I've got something to present, obviously. This is what's going on in the world. The best part to me is the questions and answers.
Sure.
And that's really why people should be there, is not just to hear me talk, but so they have a forum to ask questions. And sometimes the best questions are the ones you didn't think of, and that's why it's good to have a room full of people asking questions too.
Absolutely.
So that's really my marketing effort. Take care of my existing clients and go out and talk to people.
Well, we will put that information at the bottom of this page so that people can get that information. It's important for people to stay current on what's going on in the world and what's those impacts on their portfolio, and they need a person like you in their corner to help them walk through that very complicated maze.
Absolutely.
Is there a normal client profile? Is there a typical Patrick Yanke person that you work with?
Well, it's kind of funny, actually. I have a lot of religious organizations. I work with a number of Catholic monasteries. So I'm starting to develop somewhat of a niche in that way, because the monasteries talk to each other. And so I would say that if I'm getting a normal client, it's almost becoming the Catholic monasteries. In terms of individuals, I don't really have a normal profile for individuals. It really is, people just need financial advice. We sit down and talk. If there's a good relationship between us, and I think it's going to be a good long-term working relationship with each other, then yeah, we'll do that. I do work with businesses. I do set up retirement plans and benefits programs and those sorts of things. But honestly, the reason I do that is to meet the individuals. I really prefer working with individuals. So the retirement plans at work, they're important. You're going to get matching from your business to help you grow your nest egg. The business is going to get business deductions that's going to lower their tax bite. If you're a small mom and pop shop, then you're going to get money out of your business that otherwise you would have been taxed on that you can now defer for your retirement. There's a whole lot of good reasons to set up business plans. From my perspective, though, the reason I set up the business plans is to meet the individuals and do some planning as individuals.
Gotcha. Well, we've covered a lot of ground today, from macroeconomic issues to understanding why a client would choose you and want to work with you because of the personal relationship that is almost necessary to really be an effective financial planner. It seems, from our conversation, seems to me that person really needs to be able to open up and tell you what their life's ambitions and goals and the things that concern them are.
Absolutely. It's that old adage, garbage in, garbage out. I can only work with what I'm told.
Absolutely. So somebody needs to really be frank about, if I really want that 32-foot boat with
Exactly.
the twin engines and or whatever it is. I want my kids to go to college no matter what happens to me.
Exactly.
That was a big one on my list.
And something very important to point out before I forget to do it when we end the
Please.
interview is, I'm an independent provider. So I work through Raymond James because I don't have my own seat on the stock exchange. They do my back office functions. They do the custodianship for assets. They print statements and all that sort of thing. But the opinions and everything that I express really are my opinions and not necessarily theirs. And it's important to make that distinction so people don't think I'm speaking on behalf of a parent organization.
Understood. Well, is there anything other than the qualification that we haven't covered that you think is important for people to know as a takeaway from today's conversation?
Patience. Quite honestly, I would say patience is key. When you look at what's happened in the markets the last few weeks here, there's been a lot of turmoil out there. As oil has fallen, that's taken a lot of oil stocks down, so you see the market is down, and that makes people get very antsy. But overall, economically, it should be a benefit. So people need to be aware of that and be patient. The rotation of assets, it's going to take time, but it is happening. It is a long-term trend. Be patient. And you have to deal with the short term in the market. And the short term in the market is dealing with greed and fear. And Those are the primary movers in any day of investing, let alone 6 months of investing. And the shortest period of time in the world is the time between when an investor thinks it's too early to invest and too late to invest. And that's just the nature of it. So be consistent with their investing, be patient with the markets, don't react to the greed and fear in the short term, and be true to your fundamentals, and work with somebody who will actually handhold through the hard times and answer your questions and answer the phone when the time comes that you have questions. You know, you don't want to go it alone in this type of a market. This is a type of market when you need you need someone out there who's actually paying attention to what's going on and not just going by, this is the way it's always been done. The last 30 years is most people's investment time horizon. The last 30 years are different for the next 30 years. You don't want somebody that's just going to go with a model, but somebody that's actually going to pay attention to what's going on in the world.
Good and critical advice that everybody should take to heart. We want to thank Patrick Yanke of Yanke Financial for joining us today. I'm Bob Collier with RTP Business Live. Thanks for joining us. Any information about Patrick Yanke you can find at the bottom of this page and also at the end of the interview. So get in contact and get a little relaxation and then lower your stress level about how things should go for you in the future by talking with Patrick and getting a plan. Thanks again. Bob Collier with RTP Business Live.